My name is Scott Brovsky. Martin Kleckner and I are going to be co-moderating this panel. We've got three amazing guests that you're going to meet in just a second. I've already gone through with the startups and the founders what we're doing here, but this is meant to be an interactive experience where you're actually getting specific questions answered. Now, some of you have already texted me or emailed me or called me and said you don't feel comfortable asking specific questions that on a recorded webinar. What we're going to do is, after we kind of go through some of the more basic stuff, we will turn the recording off. If you want to stay on after that and ask specific questions, you can. So we're just gonna have to do it that way because there's too many people that want different things, so we can't keep everybody happy, basically. So for those of you that don't want to ask questions until the recording's turned off, you'll just have to wait your turn. And then I hope that people will ask more general questions, because that's the point of this with our expert panel. So let's move on. This is our team. We're Epic Small Business Development Center in the Office of Technology Partnerships at UCR. We're the ones that have basically built and are hosting and putting on this amazing thing that we're doing, which is called Riverside Angel Summit. And so the idea is that we have, as a region, we've been working in this region for about 5 years to try to build a tech scene. And one of the biggest challenges we have is that we don't have enough angel investors writing checks to early stage startups. And so the point of this is to bring more accredited investors to the scene and meet you guys who are all on this call, who are the founders. And so that's what we're doing. This is our group. We also do some other things. Martin is on a team that does SBIR, STTR grants. Martin, do you want to give a quick plug for the SBIR con that's starting here in a couple days?
Sure, absolutely. And welcome everybody. It's a pleasure to have you join us, and great pleasure to have all of the competitors for the Riverside Angel Summit. UC Riverside has spent a great deal of effort, and we've achieved a great deal of success with regard to SBIR, STTR, non-dilutive grant funding. And in addition to that, there are other opportunities in terms of corporate partnerships, foundation, venture philanthropy grants, and so forth. Every year, and it just so happens that the SBIR STTR Con, our third annual 2021 conference, is occurring the same time as our 2.5-month Riverside Angel Summit program. We are having 17 federal agencies who are joining us from the 27th Monday of September through the 1st of October, Friday. This is a golden opportunity for everybody to join us and meet with agency program officers, hear what they have to say in terms of what their research interests are and what their expectations are from us who are applying. And in addition, this is also an excellent opportunity for each of you to register for one-on-one meetings with each one of the program officers with whom you might have an interest in submitting a proposal. So if you have not received an invitation, you will. You should have received an invitation to the conference yesterday, and we are doing it continuously. If for some reason you have not received any information on this SBIR STTR Con, let me know and I'll follow up immediately. In addition, before I hand the baton back over to Scott, we also have on Friday, the 24th of September, an expert who is going to be spending 3 hours with us with regard to all of the requisites and nuances of writing a successful grant. For those of you who have never written an SBIR or an STTR grant before, this is an excellent opportunity to meet with a specialist who can guide us through all the nuances from registration, writing a study approach, recruiting participants and alliances, drafting a commercialization plan, winning the day with letters of support, and completing a successful submission for good consideration by review section. So excellent opportunity for you to learn in detail what the requisites are.
Cool.
So with that, I'll hand it back over to you, Scott.
Cool. And do you want to, why don't you throw the link to the SBIR Con so they can, if they want to register, into the chat.
Sure will. Yep.
Also, before we introduce the panelists, I want to also introduce Jennifer Ederalde. She is on our team at UCR, but she also manages one of our incubators in our region called Excite. You want to just say hi, Jennifer?
Sure. Hi, everyone. Welcome, and thank you for joining us today. I'm the manager for the Excite Riverside Startup Incubator in downtown Riverside. We're excited to be supporting over 20 companies right now, and we have 4 graduates from Excite. So we're excited to be able to support all of you and be here to help your company grow and stay here in Riverside.
And also, just so everybody knows, we support all the incubators and accelerators in the Inland Empire region. So we help them all in terms of our program helps them in terms of mentoring, helping them with fundraising, whether it's, as Martin already talked about, non-dilutive grant funding or venture capital funding. I will also say that for those founders that are on that don't know much about SBIR, 5 of the 6 startups that we've just raised seed rounds for had used SBIR grants to hit milestones to make them more investable with the venture community. So especially not so much for app companies or consumer facing companies, for any deep tech companies, which is our focus here in this region. Our main verticals we focus on here in this region are ag tech, clean energy, and also health and well, that's a huge thing. Health tech's a huge thing. Life science, health tech, biotech, et cetera. But I know that I see a lot of you who are on this, who are have applied for Riverside Angel Summit are obviously in different verticals, and you're doing B2B SaaS startups or B2C startups, and that's totally fine. But for those of you that are doing deep tech startups, SBIR can be an amazing way to move yourself along and help you get more fundable. So we'll stop talking about SBIR and let's introduce our panelists. I'm just going to go from left to right. Let's start with Shrina. Do you want to just unmute and say hi and a little bit about what you do?
Yeah, thank you so much, Scott. This has been so fantastic to see all the programming that's being put together. My name is Shrina Karani, and I'm the Vice President of Republic, which is an investment platform to be able to help startups, small businesses raise capital and also allow everyone to actually invest. I am a UCR alum back in 2013, so I'm also a mechanical engineer as well as an entrepreneur myself. So started a couple of companies, mostly in the hardware space, from computer vision all the way through to microfluidics, and then saw the massive gap in terms of what gets funded and who gets funded, and decided to tackle that myself. So very, very excited to be here with all of you today, and looking forward to being on this incredible panel. Thanks so much for having me.
Cool. Hilda?
Thank you very much. Good morning, everyone. I am founder and president of Impact Business Capital, which is the DBA of the Impact Tri-State CDC. And we provide debt capital with alternative funding sources as an SBA lender, a small business administration lender, and we're also a community development financial institution. And many people learn more about these organizations during the pandemic because of PPP and other resources that we were administering. We help businesses from startup to those who are starting, who are purchasing commercial real estate or equipment or doing ground up construction. And I'll tell you a little bit more about that when the questions are fired at us. But I'm delighted to be here, excited about this partnership. And we've just launched an entrepreneur ecosystem where we have office space available for small businesses that are getting started and seeking to launch. So thank you very much.
Cool. And last but not least, Ross.
Okay, good morning, everyone. My name is Ross Epstein. I'm with Interlink Law Group law firm. Interlink Law Group is what I describe as an international law firm that's moving towards full service. So we don't do everything for everyone, but we do quite a lot of things for quite a wide variety of types of companies, including startups is a big part of what we do. The pillars of the firm, are intellectual property, corporate transactional work, and litigation, but we have a number of other smaller practices within the firm, like immigration, which actually goes very well with a lot of the startup companies we work with, because a lot of people are coming from other places and have those issues. In California, in particular, employment issues are a big deal. So we have an employment practice. We do trust in estates. We have tax group. But the three pillars I mentioned are what we really focus on. Personally, I have been an entrepreneur myself as well. In between my two legal careers, I was in Eastern Europe for 9 years as a telecom entrepreneur. Right after the changes happened and the Cold War ended, lived the entrepreneurial experience from start to finish, including starting it up, getting it going, rounds of financing, and then exiting. And for the last 20 years have been in this intellectual property and corporate transactional practice. We as I said, we work with startups quite a lot. I'm based in San Diego. We sponsor UCSD and their incubators, and so have a number of people very much in the exact same spot that I think most of the people here in the workshop listening are at. So with that, I'll turn it back to Scott.
Cool. All right. So I've got like 5,000 windows open here and I'm trying to not lose the, here we go. Okay. So let me just see where we are here on, okay. So I'm not sure if so startups, if you want to put your questions either in Q&A or chat, I don't know what you want to use, but start putting them in so we can get them. Oh, there we go. There's one. I'm just going to make sure that everyone can see this. Looks like we got people going in both. So this is a question for Shrina from Karthik. Can you see that, Shrina, in the Q&A, or do you want me to read it, or how do you want to do it?
Might be easier if you read it out, and that way I know which one.
Okay, cool. Shrina, does crowdfunding work for deep tech companies where the end customer isn't a general consumer? For example, my customers are scientists and pharma.
Yeah, surprisingly, yes. So when I was first, breaking into the world of equity crowdfunding, I was coming from venture capital, right? And so you think about the types of companies, you always assume they're some sort of CPG company, direct to consumer company, where you are trying to get a customer who's effectively your user to actually come in and be an investor. Those are around 60% of the companies that raise through crowd equity on Republic. But actually the other 40% or so are B2B companies. So they're working on some sort of novel solution that is exciting, right, to the world around them. So we have drone companies, so B2B drone companies. We have a ton of biotech, health tech companies who are working with pharma, who are working with physicians' offices, things like that. And also folks that are, for example, working in energy solutions, right? So building management, areas where your users are not necessarily going to be in the thousands that are going to come in droves and actually invest in your company. So there is a bit of a lean towards more D2C companies, but there still is a good chunk of our portfolio that is very much B2B.
All right, cool.
And I think deep tech is actually quite exciting because it gets into the sexy space, right? Where people are like, ooh, that's interesting tech. How do I invest in that?
Nice. I'm going to answer this question that Shrina asked in the chat. And yes, Relay, actually Relay wasn't an Excite company, but it's a startup that we've mentored for almost 3 years now. And they're a B2B SaaS company that's solving the challenge of finding enough truck drivers to move all the goods that we're all buying. And they have done an amazing job. I'm going to have I shouldn't disclose his revenue because I don't know if he wants to disclose, but let's just say that they are doing a tremendous amount of revenue every month. I think probably the most successful B2B SaaS startup we have in the region that I know of at this point. Again, it's an early startup, not obviously. There are some startups that have raised larger rounds and are farther along, but he's done an amazing job basically bootstrapping for 3 years with the help of Republic and that 500K they raised on Republic. So yeah, we also have another startup that did very well. Well, more than one, but the other one that did very well on Republic is an Excite graduate, and they're called Blue Social. And I actually just talked to the founder yesterday. They're going out for a Series A this fall, and they raised what at the time was limited by the rules of $1 million on Republic. Now, well, 1,170,000. But Shrina, do you want to just touch on the rule change that you and other equity crowdfunding platforms helped put in place so that startups can actually raise more now than they could?
Yeah, of course. So just for a little bit of context, We operate under something that's called Regulation CF. So majority of startup financing happens under Regulation D funding, which is for accredited investors only. Obviously, that leaves out quite a few people since most folks are not millionaires or don't have over 200, 300K in assets. And so because we're operating under a different type of regulation and we're actually opening it up for everyone to be able to invest as long as you're over the age of 18, we are actually quite heavily regulated from a federal standpoint. So prior to, I believe it was March of this year, the most startups could raise in a calendar year was $1.07 million. So let's just say $1 million to keep it simple. We have been working really, really hard with the SEC, the Securities and Exchange Commission, and a lot of representatives on Capitol Hill to be able to change that, because $1 million is great as you're getting started, as you're going on to raise subsequent rounds of funding. It doesn't necessarily allow you to actually scale and grow your company over time. So we have gotten that changed to over $5 million now, which is really exciting. There are other types of regulations you can also raise money through. So Regulation A, for example, which is over $75 million, but I won't get too much into that now. But I think the piece that's key here is that you can actually raise pretty easily in terms of the types of regulations and filings that you have to do, up to $5 million from your own community.
And just, which, you know, not every founder, and this is one reason why we're doing this panel, obviously, but not every founder wants to raise venture capitals. And again, I don't think Ederalde, who's the founder and CEO of Relay, would mind me mentioning this, but he actually has had offers from VCs and has turned them down because he actually wants to make the truck drivers rich by allowing them to invest in his startup. And as he grows, he wants to actually help them benefit. And so I think many of you who are founders I think almost everyone I see, well, a few of you are outside the region I can see here, but most of you are in the region. And as you know, we've had a big focus on making sure that founders of color and female founders are included in this whole kind of wealth creation thing that's happening in tech. And so Republic is and other I guess frenemies of theirs, or friendly competitors in that space, are great sources for startups who may not want to go the VC route, but they have a passionate user base. And again, it's not necessarily B2C, as Shrina said. Relay is a B2B startup. So in any case, let's talk a little bit with Hilda about
one quick thing I just did want to quickly mention there is sure. Just as like an overall piece, because I have worked in VC and now I'm building a crowd equity platform, is that there's no one way to raise capital for everyone, right? And so, crowd equity is also not the silver bullet, right? That can solve everyone's capital needs. So it's really important to think really long and hard about what's best for you, what's best for your company, what's best for your ownership structure, what type of capital do you actually need, and then figure out the best path to go there.
Yeah, that's great. And actually, I got after the question for Hilda, I got a question for Ross about that. But so Hilda, we hear from, I don't know, it seems like it's a lot. I'd say, and it depends on the week, but anywhere from 5 to 10 founders every week who are early stage. So they're not ready to raise equity crowdfunding. They're not ready to raise angel or venture capital, but they need some way outside of friends and family to be able to either finish their MVP, minimum viable product, or they might need to do some customer acquisition testing. So can you talk a little bit about how those founders may be able to access capital without going the angel or VC route?
Yeah, so for debt capital that we do as an alternative lender, meaning a mission-based nonprofit lender, we are looking for those companies that we consider startup to have a business plan, and in that business plan be able to document pretty effectively, but doesn't have to be voluminous, how you're going to make money. And it also has to document projections, month by month projections that really describe how you're going to make revenue what your expenses are going to be, and more importantly, what are you going to keep and how you're going to be able to repay the debt. We have some loan programs that we're introducing, especially for women and minority, to help those businesses start the repayment a little longer. So in the next 12 to 13 months, which may help a startup who's getting started. They won't see the revenue immediately, and put them on a plan where they can make those payments later. That's the advantage of an alternative lender or a CDFI or mission-based lender. We can be a little bit more creative in how we structure the repayment to support tech companies and other companies that you all are speaking to and supporting with getting them ready for a VC or angel or some other investment vehicle.
Okay, cool. We got a question that came in for you while you were answering my question. Hilda, does the debt capital get guaranteed personally by the founder or by the company?
It's actually both. So in our programs, especially for SBA financing, it definitely requires a personal guarantee, and it also requires that of the corporation. How that's structured, we may do a UCC filing. Oftentimes we are looking for some kind of collateral as well, but not necessarily. So that's why our tools are a bit more flexible than if you went to a traditional lender, but the guarantee is absolutely required.
And so just because we have a lot of startups ask us about SBA loans, and since we are partially funded, our EPIC SBDC program is partly funded by the SBA out of Washington, but we actually, we have a team within our network that works on SBA loans. We actually focus on SBIR funding, and then, as I said earlier, equity funding. So that's angel and VC and equity crowdfunding capital. So, but a lot of founders come to us, especially first-time founders, and they're confused because they think that you don't need collateral to get an SBA loan because the government's going to help them out. And so, can you talk a little bit, Hilda, about kind of some of the differences between the debt instruments you provide versus what an SBA loan would ask for in terms of either collateral and or just, like you said, a later stage business maybe for an SBA loan?
Sure, great question. From a technical perspective, according to the SBA regulations, if someone does not have collateral, then they are not to be denied an SBA loan because they don't have collateral. It depends on who you're working with. So many SBA loans, especially the working capital loans, are administered through a bank. Those working capital loans administered through a bank, the bank has their own policies and credit standards. So while the SBA says no collateral is required if the person doesn't have collateral, the bank may have a completely different standard. And so they'd say, we're denying the loan, we're denying you an SBA loan, and they'll have reasons that may include collateral, but from a technical perspective, that's not the case. So it's really important for someone looking to make sure you look at multiple sources. Just because one person says no, one institution says no, it may be, prompting you, propelling you to look wider and broader. As a CDFI and mission-based lender, we do the SBA program called Community Advantage. Again, the SBA requirements technically say no collateral is required, but if there is collateral, for example, if someone owns a home, the SBA regulations also say if there is collateral available, in the abundance of caution, you should take it. We're still going to do a guarantee, but you should take that additional collateral. As a CDFI, we have more flexibility, community development financial institution, in terms of evaluating that collateral. So it will depend on the business plan and will depend on the small business who's getting started to look at the whole picture.
Okay, cool. And before we answer this next question about equity crowdfunding, I want to ask a question for Ross that came up from one of the founders that isn't able to attend, but they wanted to know what are some of the do's and don'ts or risks. I've experienced this having mentored hundreds of tech startups. Oftentimes the startups don't know what they're doing when they take on friends and family financing or friends and family checks, and and we're going to be doing deeper dives into all these terms that we're talking about. So if I rattle off a term you don't understand, you can put it in the chat or ask about it. But basically they end up screwing up their cap table or their capitalization table, or they end up inadvertently doing a priced round, and then they go out and they try to raise on a convertible note or a post money safe, which we're also going to talk about next week in another session. But I just want to ask Ross about some gotchas that startups could try to avoid when they're raising friends and family capital. And you're muted, Ross, by the way.
Right. So oftentimes when startups are looking to raise money from friends and family, the worst thing you can do is a handshake, right? Where somebody puts the money in because they're your parent, they're your brother or sister, they're a cousin, uncle, aunt, friend of the family, right? And without any documents that basically govern the details of the actual investment that they're making, because you should treat it like any other independent investor. Without that clarity, later on, there can be problems that come up, in the next round, for example. That's probably the most significant issue, because a lot of times startups don't have the resources or the knowledge on how to do that, right? And it's not really that complicated, but it just needs to be done. And so it's important to work with best of all worlds, with a law firm that is willing to work with you on terms and conditions that you can handle, to make sure that that's done right. It also can create a problem later on, as Scott was saying, when you're looking for your next round of financing. If you don't have a clean cap table, then you've got a lot of tough questions to answer from an investor, and the last thing you want to do is have tough questions to answer. It's hard enough going to a potential investor and explaining what your business plan is and what your forecasting is and why it's such a great investment. If you then have to answer a whole bunch of questions about, well, who are these people on the cap table, and where are the documents that show what exactly they own, and how much have you given, and what kind of rights do they have? Those are the sort of things you want to avoid, because the fewer questions you have to answer like that, the more you can focus on the actual business case and have much more success on the actual investment.
And I guess the other question I'd ask for your legal opinion on, and we have a lot of startups come to us that have, let's just say they've done probably what would be considered suboptimal, created suboptimal corporate entities at least from the perspective of an angel or a venture capitalist. And so can you just talk a little bit about that? Like, we have a lot of startups that come to us and they've done a California LLC, or they've done some other thing, and then they don't understand why most investors, at least I'd say 99% of the investors that we work with, they want to see a Delaware C-Corp. And again, I understand a lot of the folks that are on this learning process I'm not suggesting you rush out and do a Delaware C-Corp and spend money on that before you've even worked on your MVP. But can you talk a little bit about, Ross, why investors tend to like to see a Delaware C-Corp versus some other type of entity?
Yeah, so I answer this question quite a lot. I have office hours on a regular basis at the incubators at UCSD when they're asking on not only what type of entity you form, but also where to form it, right? And so there's a number of considerations. First and foremost is what exactly do you want to do with this business? If your intent is to raise capital to grow the business, then it makes the most sense to have a corporation somewhere in the world. If this is going to be a lifestyle business where you're never looking to raise any money, then an LLC is fine. The strange thing about the world today is that while LLCs have been around for decades now, they still don't seem to be as well understood as corporations. And part of that is because LLCs can be managed in any way that they want. You have an operating agreement. They don't have these strict requirements in terms of minutes and the way that you're supposed to operate them. Right. And they're intentionally that way so that they can be the sort of thing that you use for a particular purpose when you're doing business, whatever it might be. the corporate structure is favored because it is formalized, right? Every corporation has the same thing. It has articles, it has bylaws, there are requirements that there be a board, that the board meet at least once a year, that the shareholders have shares, and that's something investors understand what a share is, right? And they don't understand what a membership interest is, what the equity stake is called in an LLC, right? And so corporations, if you're going to be raising capital, is definitely the way to go, because then you don't have to, again, answer those questions. So how is this LLC run, right? Because they understand and they know the corporate form. And as far as why Delaware, right? Delaware primarily is because if you actually are successful and this business goes, right? Delaware has some very favorable rules and regulations for the company and the shareholders when it comes, when you're down the road and you actually have success. So really it's about setting things up in a way that's going to allow you to take full advantage of one of the most friendly jurisdictions in the world for companies that are going public, for example. Right, there's a whole different set of courts that exist in Delaware that are unlike any other state that deal with corporate matters, as a matter of course, and that is the main reason why people are favoring Delaware. But oftentimes, in California in particular, if you're going to be doing business in California and you're located here, and really you don't have any business anywhere else, I mean, California may be a good choice for your location for your company. Mainly because you're going to have to be, if you form in Delaware and you're doing your business in California, you're going to have to deal with two jurisdictions anyway. So it's one of those questions you want to address early. You can also move companies around. If you start in California, it is possible to move your company to Delaware, make it into a Delaware company, and vice versa. So there's a lot of flexibility built into these various rules and regulations on where you locate your company. But you want to be sure you understand what those are and have a clear strategic reason for being in one place or another. All right,
cool. And Shrina put in the chat, and I would second her recommendation. I also, as a 5-time founder, I also have owned and read that book probably more times than I care to admit. But Venture Deals by Brad Feld is one of the best. There's also 3 or 4 other ones that we'll recommend in future workshops that we're doing, but that one is kind of the classic. And Brad Feld is an amazing just person in general, I think he's still based in Boulder, last I heard. But anyway, next question is for Shrina. How long does Republic crowdfunding take to raise? And is it up to the company to promote themselves to attract investors? Similar to how Kickstarter works, and you really only want to succeed as a company if you get on the homepage and have early traction. So I guess the question is how much, I guess the question is how much of an audience or customers or whatever would the startup need to have before they would be able to have success on your platform or other crowdfunding platforms?
Yeah, that's a great question. And I think one thing I just wanted to quickly clarify is that we do both equity as well as debt-based crowdfunding. And so there is an opportunity to also do revenue share as well as just sort of simple debt with Republic as well. So happy to go into that as well and share some more resources there. So in terms of the timeline, it really depends on you, right? So we've had companies that have their communities geared up on day one and have raised $1 million in less than 24 hours, right? We've had other ones that want it to be more of a marketing exercise, right? They're using as a way and almost as an incentive for their customers to sort of use it as this intersection of marketing as well as raising capital and effectively take their customer acquisition cost and make it negative. So I think there are a lot of different ways on the reasons why people decide to go the equity, crowd equity route. And it really depends on you, whether you're trying to just raise capital and do that as quickly as possible, or you'd actually rather have it be a longer sort of exercise and almost as like a marketing campaign, right? On average, it's roughly about 90 to, about 3 to 4 months. And that really comes down to how much capital you're trying to raise, whether you have to do a financial audit with a CPA or not, depending on, how much you're raising and what the regulations around that are. But I would say on average, if you had to put a number on it, it's roughly 3 to 4 months. In terms of how you're bringing capital, once again, it very much depends on the company. On average, it's about 40 to 60% of the capital that you're trying to raise that you will bring. Republic has a couple of levers that when you hit certain targets, we will blast it out to, we have over 2 million members on Republic. And so we will blast it out to our base. We'll, single launch emails can generate, upwards of hundreds of thousands of dollars. And so Republic does have a couple of mechanisms in place that sort of help you level up, but the base does come from your community. And then there are different ways that Republic can help you get more.
Very cool. Yeah, that is something that, and I can say, having worked with a number of not just the equity crowdfunding platforms, but we've also helped mentor startups on the other platforms like Indiegogo and Kickstarter. And there's probably 15 now. I don't know how many there are. There are a lot, but yeah, I mean, it's case by case, and it's interesting. I mean, we've had some startups that have, we thought would be like a no-brainer for either crowdfunding or equity crowdfunding that have done okay, but not great. And then we've also, as we mentioned earlier, had some startups that have just, maxed out quickly. And so it's interesting. I guess it's more of an art than a science, I think, at this point. Although I would say that, do get in touch with us if you are thinking about equity crowdfunding, because there is a lot of junk out there in terms of platforms, and I'm not going to obviously name any and get a lawsuit for UCR, but they're just some ones that aren't that strong. And obviously we consider Republic to be one of our key partners in that space. And there's a couple others that we also have worked with startups that we mentor. So I just would say, like, do your homework just like you would with anything else for your startup, just like you would with any investor that you may take an angel check from or any VC, and make sure that you're working with a reputable equity crowdfunding or crowdfunding platform, because you don't want to, be there with a bunch of other junk. And then the other challenge for that, of course, is that if you go on a platform that's not really that great a platform, then let's say the raise doesn't go that well, then future investors, that's going to kind of always exist, and future investors are maybe not going to be as excited to invest in you if it looks like you were on a subpar platform and you didn't raise the capital. So just something to think about as a startup.
I think one big thing I would add on to that is, just to your point, is to really look at anytime you're raising capital, if it's coming easy, ask why. Right? If the process seems, whether you're talking to an angel investor, whether you're writing a grant, whether you are trying to raise venture capital, whatever it might be, really think about where that money is coming from. And the fact is that, unfortunately, none of it's easy. Everything takes time. Everything takes, that first meeting, all the work you put into writing the grants, whatever it might be. Unfortunately, the money doesn't come easy. And so regardless of the path you take, just acknowledging that there is a process, that it is going to take a little bit of time, and the money isn't going to show up on your doorstep, the next day. So that's the unfortunate reality of it. And because of that, Republic actually we do diligence on every company that raises with us. So it's not an open platform. So we are quite selective, but we have an over 90% success rate. So the capital you go out to actually raise with Republic, we have a smaller subset of companies, but there's a higher likelihood that you're actually going to raise that money, because we know it's time consuming. And especially as a founder of a new company, you need to be building your company and not focusing your time on fundraising. So we always want to make sure we're optimizing your time and making sure you're spending it in the best way.
Okay, cool. I think you just answered another question, which was, you just answered, how often do companies fail to raise in Republic? You just answered that. So, I guess then what happens if they don't reach their target, I guess, is another follow-up on that.
Yeah, if you don't reach your target, then you don't get the money. So we work with companies to make sure that there is a range. So we have you set your minimum of the sort of the lowest amount that you're willing to take for it to be worth it for you. Also, because there's regulatory requirements, right? So if the minimum, if we're going to say $5,000, and you're still having to file your Form CAR, you're still having to do all these regulatory pieces in line with doing this type of offering, it's honestly just not worth it. So we want to make sure that whatever path you take, it's worth your time ultimately. So we work with every company to make sure we're setting realistic goals, both in terms of the minimum as well as the maximum.
Okay, cool. A question for Hilda. Does the community funding that you provide is it only for nonprofits, women, or minority-run companies, or is it for everyone? It seems like a clear winner versus SBA funding since it supports early stage. So I guess the question is, I can answer this. You work with everybody, but I mean, I guess.
Yeah,
Go ahead.
we actually, good question. Thank you, Scott. We actually don't fund nonprofits. We are a nonprofit, but we don't fund nonprofits. We only fund for-profit entities, and we work with everyone. And I was really pleased to hear, actually pleasantly pleased to hear Sharina's comment. If it sounds too good to be true, it is, right? So you may search the internet, or you might get a check in the mail, or you might get on an internet website and they'll say, we'll get you your capital in 24 hours or 48 hours. Well, if it sounds too good to be true, it is. You may be paying 130% interest on that. And I can tell you, we've worked with companies that have gotten loans, I won't say the name, from certain groups, fintech lenders on the internet, and before they know it, that loan has gone up multiple times. They're pulling the cash right out of their accounts on a daily basis. And one of my clients, who started out at a $25,000 loan, she had no idea how it went up to $50,000, and she was paying $4,000 a month. And
Wow.
she just didn't even know how it happened. She said, they keep pulling this money out of my account and it keeps going up every time they pull. So really, really great advice, Sharina. Do your homework. Recognize it's going to take time. With any SBA loan or any of our community lending loans, it takes time. About 90 days is a good timeline to think about. It could be shorter, but plan in such a manner that you know it's going to take time, and it's going to be responsible lending from our perspective as an SBA or community lender, such that we are not seeking to put you in a loan that's going to ultimately cripple your ability to continue to grow.
Yeah, and to that point, there are easy ways to validate, right? I think Scott and Martin are incredible resources. So reaching out to them and seeing if they've heard of the platform before. Have they heard of the partner before? Is this a path that maybe they might not recommend it either way, but they could say, yes, we've heard of them. Like, they're not a scam, right? Also looking at who else they funded. Normally, programs that are well established will have a page of companies they've backed, right? Organizations have already worked with. So take a look at their portfolios, take a look at who they're working with, and try to get some sort of sense of validation, whether it's a personal, someone that you know, like Scott or like Martin, or just doing your research and seeing who's actually used them. So make sure, Hilda, that sounds awful. It sounds like that was,
yeah, it was awful, and we were able to help, but sometimes they get in those situations where it's even hard to help to get them out and refinance that debt. So really, really read the fine print, ask questions, and if it sounds too good to be true, it is.
And so a question that came in for Ross is, or anyone who wants to answer this. I mean, I can also answer, but I think we should let Ross answer this. So what are your thoughts about a startup working very early with a corporate partner or an industry partner for funding? Do you have any thoughts on that, Ross? Have you seen some of your clients do that, or do you have any advice for a founder who may be contemplating that?
Yeah, I think it, obviously the answer is, and this is the answer you get from every lawyer on every question, is it depends.
Right.
It always depends on the circumstance, right? It may or may not be a good fit, but if it is a good fit, let's assume for the sake of the answer to this question, it is a good fit. It can be a great way to grow your business. And in particular, there are certain industries that are really this is a very common structure. I mean, for example, in life sciences, it's very common for big pharma to do deals with small biotech companies and small device companies where they have done a good job on protecting their intellectual property assets. They've taken their drug discovery program to a certain point, maybe phase 1 or maybe in clinical trials, or even getting to some point that's interesting enough to show that this could be a promising drug. And they can do a licensing and collaboration agreement, which includes quite a lot of money to continue to develop the particular drug, for example. I'm just giving one example. And it's a great way to finance the business because ultimately that partner could also be an ultimate acquirer, which seems to be a common way for at least biotech companies to start up, get going, get it to a certain point, take it to where they create a lot of value, and then have a really nice exit when that pharma company buys them, right? But it's not just in that area. It can happen across the different industries. But like in anything, it has to be at the right time, right partner, because again, some industry players are very, very predatory, right? And others are obviously more friendly. So it's going to be a case-by-case analysis, and you just have to be careful. Make sure you get good advice from your mentors, from your advisors, from whoever your lawyers are. And then, of course, the deal itself needs to make sense, right? So the devil's always going to be in the details.
Okay, cool.
One quick thing I just wanted to add on along with Ross's point around having a trusted lawyer. There was a question around needing a CFO, especially at the early stages. You don't need a CFO, at least from our perspective, but get yourself some counsel, whether that's a friend, whether that's like a startup lawyer who's willing to provide pro bono services or do it for cheap because they're hoping that you're going to grow and they'll be able to support you throughout your growth. Whatever it might be, find someone who can actually help you and understands the laws. Because even as someone who works very deeply within all these regulations, I'm pinging our counsel every single day. So just get a lawyer. None of this is legal advice, except maybe from Ross, but he'll probably have to say the same thing as well. So, find counsel that you trust because it's so important as you start raising capital.
Yeah, one thing I've noticed on the majority of the applications that came in is for the Riverside Angel Summit, what we're all part of here. Many of the startups did not put any financials in. Now, I don't know why. I would encourage you to put them in. If you don't have them, then we spend a tremendous amount of time. Our mentor team of 15 mentors, we spend a tremendous amount of time helping startups with their pro formas and getting working on their revenue model, business model, go-to-market strategy, that kind of thing. But we probably won't have time to do like some quick. I mean, like we're not gonna be able to get it solved in a couple of days if you don't have anything. But I recommend, like Shrina said, reach out to a program like ours or a trusted friend. What I would say, though, I would be careful of is I talk to, at least on a weekly basis, a startup that had a friend who was an attorney, and maybe a divorce attorney or some other attorney helped them with their startup, and they had no idea what they were doing, and they put them in a situation where it's a complete mess to try to unwind what the friend did or the friend of a friend did. So not that these folks don't mean well, but if they're an attorney that doesn't understand startups, then they're not really that helpful, unfortunately. So just kind of be careful of in terms of the friend network, who you go out to. And I'd say the same thing, just because someone does the books for some existing company and they're a nice person, they may not have any clue on what you're trying to do as a startup in terms of creating your pro forma and raising capital. And also don't forget that everyone has the hockey stick, but you've got to be able to justify the hockey stick, especially when you get in front of accredited investors or venture capitalists. And that is something that as founders, you're just going to have to deal with and get good at and do. So, you can get help and you can get mentors, but at a certain point, you're going to have to know this stuff cold in terms of the financials as the founding team or the founder. So wow, Karthik, you are a question machine. Hold on. Does anyone else, first of all, sorry, Shrina, does anyone else have any questions? Karthik has asked a lot, which is great, but I know that there are people, I see founders on here that have asked me questions that aren't asking questions now. So don't be shy, ask the questions. Yeah.
Hilda had something to add, so I just wanted to
go ahead. Sorry, Hilda, go ahead.
Oh, I was going to jump. Yeah, Scott and Karina, Shrina, I would just re-emphasize, build your bench and be responsible as a founder. You do have to know your numbers. Even if you don't like numbers, you've got to know your numbers. You got to figure out how to know them well enough to be able to explain it. Whether you're meeting with an investor or you're meeting with a banker or a community lender, you've got to know something about your numbers. And I would re-emphasize what Scott said. You've got to make sure that you know, it is the responsibility of a founder to know the numbers and to get comfortable enough to at least have a conversation about your numbers as it relates to your idea, as it relates to your pitch. It's really, really important. And building a bench of professionals. Great to have friends. You can run stuff past friends, but a bench of professionals who know what they're doing in the area that you're working with, whether that's an accountant, your attorney, and other trusted advisors who's going to help you build this company that you may sell, but you really want to have a good bench, a good team. And Scott and Martin are a wealth of information to be able to do that. And I'll pitch further the SBA, the Small Business Administration, that has a number of resource providers who have been vetted to try and help you as a founder to have the greatest amount of success, and your tax dollars contribute to those professionals who are supporting this effort. So great comments, and can't overemphasize it.
Cool, thanks, Hilda. So here's a question. I'll come back to yours, Karthik, but from Helen, how deep are you expected the financials to be? For example, we have a one-page summary, but I suspect you expect more than this, correct? So basically it's a question of, yeah, that's a great question, because we have this a lot where a startup's just done a pitch deck with a hockey stick financial slide, but they actually haven't built a financial model, and they actually don't have any details. So I think any of the panelists can answer that question about how deep you'd like to see the financials be.
Yeah, I think every investor is different, right? And whoever you talk to, some might have more of an emphasis on financials, others won't. A lot of the VCs that I've worked with actually don't care about the financials that much, because it's too early. What they care about, because they know it's going to change, they know that like whatever numbers you're putting together are not actually viable. What they're looking to see, and what we looked for during our diligence, was your business model, right? So how are you going to make money? And the second piece is your traction. That's actually more important than everything else, is showing validation for your idea. You can show this incredible, well built out, I don't know, using all sort of Excel macros, whatever you need to do to build out a great financial model. That doesn't mean much if you haven't done anything to actually test it. So especially at the early stages, and I can say this is more from Republic's side and also from the VCs that I've worked with, it's not so much about the financial model, but actually focusing on the business concept, the business model, and getting that early validation that goes way further than any built out financial model you'd have. So to your question, I think it was Helen that asked it, I believe.
Yeah. Oh, I already dismissed it, but it basically was how deep are the financials expected to be, was her question.
For us, that one pager would be okay if you're looking at your market size, if you're actually breaking out your total addressable market, if you're looking at what's your go-to-market strategy rather than what's your month-to-month projections. That's not something that we care about, especially at the pre-seed, seed stages. When you start getting to Series A, Series B financing, yes, Republic's going through our Series B right now. And when you're actually looking at, sharing, much larger amounts of capital that you're looking to get invested, you need to have very robust financial models. But when you're talking about the pre-seed and seed stages, you just need to have something that makes sense and not just a hockey stick graph, but something that, looks realistic, but more importantly, how are you going to get there is what's important. And that's my take. And I know that, other investors do look at other things differently.
Can I add something?
Yeah.
So I think along those lines, your business plan, which you need to have whenever you're going out to raise money, is kind of like a resume, right? Because the reality is, I don't know about all of you, but I have rarely seen a business plan that was put out very early on that actually was executed on all the way to the end. And that's one of the reasons why you always hear about the management team being so important, because it's somewhere along the way, things are going to happen that you can't possibly have foreseen when you put together that first plan. And you're going to have the ability and flexibility to change direction, to deal with whatever has come up. Because again, to Shrina's point, the numbers you come up with in the early stages, while they may look great and sound great, the reality will be different, whatever that reality is. It may be extraordinarily better. It could be worse. It could be something close, but something about it will change your trajectory in some significant way, and you need to be ready to change with it.
Okay, cool. Also, I just want to give a time check. I don't recall if all the panelists had hard stops after an hour, but it is a little after 12:30. We can keep going with answering questions as long as the panelists can stay on. But if you do have to drop off, feel free to drop off. But we'll keep going here. So let's see. We had a Karthik question. How do you validate traction for a company that's doing R&D? Technical milestones? Is it unlikely that these kinds of companies get funding?
I can take a stab at that. So from our perspective, what we look at for R&D companies in particular, yes, is technical milestones. It depends on, honestly, what type of company it is, right? So some are, for example, if you have to go through FDA clearance, we know that's going to take 3 years down the line at some point, but often they've gotten some sort of partnership agreement signed with a validating company. They have, something that shows that they're out there trying to figure out if what they end up developing and ends up getting approved 3-5 years down the line is going to have a business application, right? And so we want to vet both the technical side, but we also want to vet the business case for it. The other piece that can be really helpful, depending on who's on the founding team, to Ross's point, is if you've done something similar before, right? So say you've done some sort of R&D company before, you've actively done research, this is something that someone on the team has experience with, that in and itself can be traction, right? It's like, we've done this before. We've made money off this before. Let me show you how we're going to do this again. So it really depends on sort of who you're talking to and exactly what type of R&D company that you have. But traction can come in many different forms. I saw another question around commitment letters. Commitment letters actually don't mean very much, unfortunately. It's great from a business perspective, but unfortunately, from an investment perspective, it's not booked revenue, right? It's not showing that, they're committed to, not even just committed, but they've inked a contract saying they are going to work with you. Unfortunately, the sort of like LOIs and commitment letters don't go very far with investors. Once again, that's in my experience, and every investor will tell you something different. So that's just sharing my take.
Yeah, and I'll just add to that, since we work with a lot of deep tech startups, and I'm helping raise capital for 2 clean tech and 3 ag tech startups right now. And one of the things that the investors that we're introducing them to, they want to know, they do want to know your TRL level. They do want to know things like that. And so I'd recommend that if you are a startup that is a deep tech startup, and you don't have obviously early customers or traction or revenue in terms of those type of metrics, but you have hit certain milestones, like Shrina was saying, like maybe you're getting ready for your first, to get on your FDA, an FDA pathway or an EPA pathway or something like that. Stuff matters. And also, do you have a working prototype that's been tested by any customers, even if it's like a free trial? So yeah, definitely have all those things ready to answer for at least the investors we work with. And these are all seed stage VCs. We don't, I know they're out there, and I work every day, every week to try to meet more of them, but we don't have a very strong, a group of what I would consider deep tech angel investors that we're connected with. So most of the investment we get in for the deep tech startups comes from seed stage VCs. And so anyway, we can talk more about that offline if you're a deep tech startup. And then another question from, let's see, I'll get to yours in just a second, Christopher, because Cassandra had one in the chat, which I missed. So let me get to that one. What about an established company wanting to venture out with a new idea? So I guess that's a great question. Actually, we talk to a lot of companies that have maybe grown to a certain level, like maybe they're like a $12 million business in a certain vertical, and they're trying to figure out how to either raise the capital or get the capital to launch another either division or product or whatever. So I don't know if anyone on the panel wants to take that one.
From an SBA perspective or community lending perspective, you have a track record. And so for that track record, you obviously you get credit for that track record. And so while you have a startup venture, which is the way we would see that, a startup venture in your new vertical, we would be able to look at your existing success And we probably will want to have a cross-collateral or prospect guarantee of your existing success to support being able to fund your startup venture or your new vertical. But there's absolute value in that from doing that from an SBA perspective.
There's a business rule that I think has general applicability, and of course it doesn't apply to everything. But in terms of the level of risk of starting a new venture, if you're doing the same thing that you've always done in a new market, that's a relatively low risk thing. But if you're doing a new thing in your market, again, that's relatively low risk compared to a new thing in a new market. So when you think about branching out from an existing business, you have to make sure that what you're doing has a level of risk that's not only going to be good for your particular business, but also in terms of raising capital, you're going to be able to convince potential investors that you have the capability because you're just leveraging existing assets in a new direction as opposed to just starting everything over again. So it really kind of depends on what you're doing. But as a rule of thumb, you want to avoid that new thing in a new market if you can.
Yeah, I would +1 to both what Ross and Hilda have shared. I think the main piece there is that it completely changes how you pitch it, right? So if you're looking at doing something new in a new market, you're pitching a new venture, and then you can show that, hey, look, we've done this other thing before, and that's your track record as an entrepreneur, but that's not necessarily your track record as a company. If it's another product on your existing roadmap, great, you're just raising growth capital to do more of what you're already doing, right? So I think depending on that risk sort of profile that Ross was talking about, it completely changes how you're pitching it, whether it's your track record as an entrepreneur and what you've done before, or whether it's just, hey, our company's growing, we're expanding into this new market or into this new sort of space. That's why we need them, raise more capital to continue doing what we already do really well.
Yeah, and I just add, that's something we've been helping a lot of startups with, especially during the pandemic, is pivoting their business and also looking at, are you really thinking about all the ways you could monetize your existing business? And so we have some amazing mentors on our team that I would consider talking to if you are thinking about a business pivot or about potentially thinking about your business in a different way. I don't know if Jennifer, if you can throw that link to the series we're doing on data, big data, and if you can throw that link in the chat, that would be great if you can find it quickly. But I'll just do a couple of housekeeping things here for the folks that are going to, because these questions are coming in not just on this, but also via email for other startups that are going to watch this after the fact. Helen, yes, you can add in anything you want into your application for Riverside Angel Summit. You can update your pitch deck. You can update financials. You have access to that. It's not shut down. So you can add in new things, or if you forgot a document, please put it in. And I will say to those of you, we've lost a few, but those of you that are still on, if you have not put in things like a pitch deck or more details, it is going to be a massive challenge for you to move forward, because many of the startups that have applied to this are extremely buttoned up with all of thanks, Jennifer, are extremely buttoned up with all of these things that we've been talking about. And so if it comes down, when we're cutting down to 24, and if it's between, even though if we know you and we know you're great and we know we love you and your startup and your technology, if you've just done a few sentences in the application and another startup that we're looking at has a pitch deck, financials, executive summaries, and all that stuff in there, you're going to get cut. That's just the reality of it. So I would put in as much information as you can. And I understand that if you don't have it, you're probably not going to be ready to have it before the cut down in October 1st, but you could try. So that's just an aside for those of you, because there are several of you who have not put in enough information, and you're going to get cut right away, just so you know. So that's a long answer to Helen's question there. Christopher asks, how can you show traction if you don't have the software to use yet? I'm looking for funding in order to develop the MVP. Are there commitment letters? Okay, so we already answered the commitment. Shrina answered the commitment letter question, but I just want to say, I talk to startups literally every day about this question. You got to build an MVP. The reality of you raising capital that's outside of your friends and family network to build a product, whether it's a hardware or a software product, is basically zero. So I would recommend that you do anything you can to build your product. And so that may, and this is going to be a question for Ross, that may include bringing on other founders who can help you do that. And we will have other sessions coming up that will go into more detail on this, but in terms of how you would structure that, if you, like, let's say you had a Delaware C-Corp and you were the only person on your C-Corp and you wanted to bring on a CTO, that's a negotiation between you and that CTO about what he or she would expect in terms of equity and compensation. Obviously, if you don't have money to build your startup, you're not going to have money to pay him or her to be your CTO. So it's going to be all about equity. So I would just say that do everything you can to get your MVP built, but it is, please do not waste your time going out and trying to raise angel or venture capital with no product and no traction. It's just not going to happen. And people don't like to hear that, and I get it, but it's just the reality of the situation. And if the panel wants to disagree or add anything, please do.
One thing I will add, I don't disagree at all. One thing I will add is that there are some, I mean, and maybe Excite is even one of them, but there are a bunch of, programs out there that don't require you to have an MVP, right? And so get the help you need, try to build your network, try to build your connections, get your CTO if you're not the technical person on the team, do all these things before you go out and raise capital. But there are a lot of resources out there. And so try to make sure you're not paying for too many of them, or really any of them if you can, and really leverage all of the programs and things like that, especially in the Inland Empire. There are so many now that you can get access to. So sorry, I keep plugging Scott and Martin, but reach out to them. Like they're here to help. So, let them help you.
No, that's a good point. I mean, yeah, we can definitely help, but we can only help to a certain point, and we can't build your MVP for you. So that's the challenge, but it's all about, for this startup game. And this, again, our program and this Riverside Angel Summit is focused on scalable and tech companies. So, again, they're also, to Shrina's point, there are also some great programs that aren't our program that help small businesses and people who are looking to open a restaurant or whatever it may be. And we can connect you with those folks. But as far as this cohort, this is all tech or scalable startups, because you wouldn't be on this if you weren't. But for any of your friends who are starting businesses and they want that help, I agree with Shrina, reach out and get that help. And Jennifer just put into the chat some more info about Excite and how to contact her if you're interested in the incubator program that Shrina just mentioned. Okay, another question. Traction is important, which can drive your business model, but is the exit plan and potential ROI not more important for VCs? Well, I think we can all answer that, but anyone who wants to jump in can jump in on that one. All right, I'll jump in. Go ahead, Shrina. Go ahead, Shrina.
No, I was just going to say, first of all, it depends on who you're talking to, right? But secondly, yes, of course that matters, but that's an assessment that the VC is going to do, right? So if you're talking about having limited time and where you're going to be putting your attention and creating a pitch deck or creating the plan or whatever, yes, of course, think about, from the perspective the investors looking at this, like, how am I going to make money? But that should be spelled out in a way through your entire plan, not just on one slide, not just in one section. It comes through in terms of your total addressable market. It comes through in the traction and how you're building a good business. It comes through in why your business model is innovative. It comes down to why your team is the right team to win. So that is sort of, at least for me, that's spelled out throughout. And one slide at the end telling me I'm going to be a billionaire in a year is not going to convince me, right? So I'm making that assessment as I'm evaluating a company through every single stage and every single aspect of what they're doing. One thing that I've seen that it's helpful if you do want to include an exit slide is including comparables, right? What are other companies in your industry that have had an exit, and just put those logos out there, right? Those logos tell a better story than any sort of model or any sort of thing that you could potentially create yourself. So that's my sort of quick take on it. I think Scott, I don't know if you had anything else you wanted to share there.
Well, I just want to say Hilda is going to jump off, and Hilda, we just wanted to thank you for joining us and for all your help, and also for all that you and your team do for the community. I don't know if you can still hear us, but I think we might have lost. She's still on, but we might have lost her. But I just wanted to say thanks, Hilda, for everything. And if anyone has any questions, her information is there up in the chat. But also we can get you in touch with Hilda and her team if anyone needs to connect with her. And so yeah, we can probably wrap up here in a couple of minutes. We'll just hit a couple more questions while we still have a few folks here. And so Christopher asks, when it comes to the competition, are we required to have a C-Corp in place If we're to be awarded anything, I've already initiated a Delaware C-Corp. No, so the question is, I think Christopher's asking if they have to have a Delaware C-Corp in place in order to progress in the Riverside Angel Summit process. No, that's not part of it. We were just talking about what I think Ross was saying, and what I was saying is that if you plan on raising equity capital in the future, the vast majority of investors prefer you to have a Delaware C-Corp. So no, you're not going to not be eligible to move forward and potentially pitch on November 4th in front of the accredited investors if you don't have Delaware C-Corp. So that answers that one. And then Christopher also asks, where can you find those resources? Is there a registry or place we can go? I would just say, send us an email and we'll connect you. Depends on what you're looking for. If you're looking for an incubator, as I said, we've got, I don't know, officially now, I mean, I'd say there's like, well, I don't want to say, I got to be careful because we're partners with all the incubators and accelerators in the region. I'd say there's 6 strong ones right now across all of Inland Empire that would be helpful depending on where you're located. And also depends on what vertical you're in. So for example, our friends at Fourth Sector Innovations in Ontario, they're focused on commerce and logistics startups. So if that's something that is your business, then that would probably be a great place to go. We also have Murrieta Innovation Center, which focuses on genomics and med tech, med device startups. And Jennifer already mentioned Excite takes on all verticals. There's also an incubator in Temecula. I believe there's one out in Coachella Valley and Palm Desert and Palm Springs, Joe Wallace's program at CVEP. And we can get you all that connection information depending on where you live and where you're located. And we also have just opened a life science incubator, which is in Riverside on campus. But the cool thing is it's open to the community too. So you don't have to be a professor or a grad student. You can actually, as an entrepreneur, you can actually apply to be involved with the UCR Life Science Incubator. And we've got about what, Jennifer, almost $2 million of state-of-the-art equipment in there. It's in like one of the most amazing buildings in Riverside right now. It's a LEED Platinum certified brand new building we built on campus. So it's very cool to, actually, do you want to throw up, I don't know if there is I guess just contact you, Jennifer, if they have interest in either incubator, right? The wet lab
Yes,
or Excite.
definitely.
Okay.
We can connect you to the right people.
Okay, cool.
Can we do a tour
yeah.
of the labs? These sound incredible.
We also have Hilda put her information there. If you need her email is in the chat. So, and I know that some of you are going to watch this later aren't going to be able to see the chat, obviously, but you'll just have to ping one of us that to get the info. Because as I said, unfortunately, half the founders have emailed or texted and said they're going to watch this later. But in any case, any other questions from the founders we still have on before we wrap up? Just throw it in the Q&A or the chat. Otherwise, I think, hey, Martin, do you want to tell these founders that are still with us here about a couple of the cool things we have coming up in terms of some of the other workshops we're doing on Monday and what?
Well,
Tuesday, Wednesday?
sure. Yeah. And great job, everybody. First of all, thanks to our panelists, and Scott, you ran that like a maestro, which is fantastic.
Well, thank you. Yes.
I would like to invite everybody to meet with an experienced venture capitalist and angel investor with the Tech Coast Angels. He actually invests money, and he has founded several successful companies. His name is Bill Waldo, and he's going to be joining us at this same time on Monday. Actually, it's at 12 noon rather than 11:30. So make a note of that. But if those of you, if you've never been through this process before, and if you're green, Bill Waldo is the guy who will be able to take you by the hands and walk you through this entire process. So I will highly encourage every one of you to register and participate and meet with us. Scott and I will, of course, be there, and Bill will be likewise there, obviously. And for those of you who are planning for, and if you aren't, not certain why you're here in the first place, but planning for seed capital, Bill Waldo will give you an inordinate amount of insight from personal experience as a startup founder, and also from the experience of an investor. And both Scott and I, by the way, have worked with Bill Waldo for a minimum of a decade. So he has been there, he's done that, and he knows what he's talking about. So highly encourage all of you to join us on Monday at 12 noon.
Okay, cool. And then I guess I'll just do a plug for my, oh wait, let's see. Helen asks, no, Helen, that's the same. Sorry, I'm having some mouse control trouble there. Yeah, no, that's the same workshop. Giving your best pitch. That's the same one. Yeah. There's some confusion in terms of some different, anyway, there's emails that have gone out and there's the website. It should all sync up, but yes, that's the same one that we're talking about. And then I'll do a plug. When is mine, Martin? Tuesday, the 21st?
Yours is Tuesday.
Yeah, mine's Tuesday.
Yeah,
so,
it's going to be a very, very busy week. So Scott, you are on Tuesday. Absolutely.
Yeah. So what we're going to be talking about, what we do with the startups. So we've helped startups raise about $31 million in the last 2 years in capital for the startups that we mentor in our program that we've just been talking about. And so what we do is we put each startup through, come up with an investment plan. And so what we're going to be doing is we're going to be going through that with all the founders who are trying to raise capital. And we're going to be talking about, well, a lot of things, but the main thing is how do you start and how do you track things, and what do you do to raise capital? So it's going to be kind of an extension of what we talked about today, and also what Bill Waldo is going to talk about in terms of your pitch. But this is going to be actually like a little bit in the weeds of, like, we're going to go through creating your investor spreadsheet, or you can use other tools out there that are, there's some SaaS companies that have good trackers. But the idea is that you want to start building out your investor list. We're going to talk about how to do that, how to optimize it. We're also going to talk about investor strategy. So when are you ready to go out for angel? When are you ready to go out for equity crowdfunding, or ready to go out for your series seed? And we're going to talk about some specific metrics, because a lot of founders are confused about when they should apply or go out for what. And we're also going to talk about how unbelievably hard it is to raise capital. So
so come prepared with questions for most.
Well, yeah, not only that, but this is like a working session. So
Yeah.
if you have your Excel spreadsheets built or you're building them, we're going to go through
Bring
them.
it.
Yeah, bring it all. And anyway, and then that's just 2 more of the 13 more of these that we're doing to try to help founders raise capital. So we want to thank Ross and Shrina, and
Absolutely.
of course, we're already thanked. But thank you so much for your time and for all you do for startups, both of you, and Jennifer for all you do for startups, and Martin for all you do for startups. And yeah, anyway, so thank you all so much. And we'll talk to you all soon, and hopefully see you all next week.
See you on Monday.
All right, take care, everybody.
Thank you
Bye.
all.
Bye.